Investing in stocks, bonds, exchange-traded funds, ETFs, mutual funds, and options can be a great way to diversify your portfolio and grow your wealth over time. However, it is essential to understand the differences between these types of investments before committing any capital. This video will provide an overview of each financial instrument, including the risks and potential returns associated with them. Note: invest at your own risk. This video does not guarantee success implied or otherwise. Stocks. The stock market is a dynamic and integral part of the global economy. It provides investors with an opportunity to invest in companies, helping them to grow their wealth. In 2020, the stock market has been volatile due to economic uncertainty caused by the COVID-19 pandemic. Despite this volatility, many stocks have seen strong gains so far this year. Investors can purchase stocks through brokers and online trading platforms, allowing them to take advantage of price movements in the markets. Investors should research potential investments thoroughly before committing any funds, as it is important to understand how each security works and what risks are involved. Stocks can be used as a long-term investment strategy or as part of a portfolio diversification strategy. However, investors should always consider their risk tolerance when selecting investments. Bonds. Bonds are a popular investment choice for many investors, both small and large. They are considered an attractive option due to their low-risk nature and the potential for steady returns. While bonds come with risks, they can be a great way to diversify any investment portfolio. When investing in bonds, there are a few key features to consider. These include the type of bond being purchased, government or corporate, the maturity date at which the investor will receive their principal amount plus interest, and the credit rating of the issuer. The higher the credit rating of an issuer, typically means less risk associated with that bond investment. Additionally, it is important to understand whether interest rates on new investments may decrease or increase over time, as this could impact your overall return rate on your bonds. ETFs. Exchange-traded funds, ETFs, have become increasingly popular investment vehicles among both institutional and individual investors. An ETF is a type of security that tracks an index, commodity, or basket of assets like stocks, bonds, and other investments. ETFs can be traded on stock exchanges throughout the day at market prices just like individual stocks. Investors use ETFs to diversify their portfolios because they offer low costs, tax efficiency, and diversification benefits over owning individual stocks or mutual funds. They are also highly liquid investments that can be easily bought and sold on exchanges. Unlike traditional mutual funds, which are priced at the end of each day based on the closing price of their underlying securities, ETFs trade continuously throughout the trading day at market prices set by buyers and sellers in real time. Mutual funds. Mutual funds are an attractive option for people seeking a diversified, long-term investment. A mutual fund is a portfolio of professionally managed securities that pool together the money of numerous investors. By investing in a mutual fund, you can gain access to various stocks and bonds with little effort or knowledge required on your part. Typically, mutual funds have a fund manager who chooses which investments will be made, taking into account current market conditions and the objectives of the particular fund. This can result in greater returns than individual investors could achieve by themselves, since they may lack the resources to research and manage their own portfolios. Additionally, many mutual funds provide liquidity due to their size, as well as potential tax advantages for investors when compared to other types of investments. Options. Options are a great way to diversify investments and minimize risk. Options contracts give investors the right, but not the obligation, to buy or sell an asset at a predetermined price on or before a certain date. This flexibility can be used to hedge against potential losses or capitalize on market opportunities. There are two types of options contracts: call options and put options. A call option gives the purchaser the right to buy an underlying security at a specific price, while a put option gives the holder the right to sell an underlying security at that same specific price. The amount paid for this contract is referred to as its premium, which is determined by several factors such as volatility and time until expiration. By leveraging these contracts, investors can reduce their exposure to financial markets without taking on additional risk. In conclusion, it is clear that there are many options available to investors when they decide how to best manage their money. Stocks, bonds, ETFs, mutual funds, and options all offer different levels of risk and return. It is important for investors to understand the differences between each type of investment and their own financial goals in order to make an informed decision. Having a good understanding of the risks associated with each option is also essential for successful investing. Don't forget to like, comment, share, and subscribe for future content. Thanks for watching.